to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Nothing's going to be final until April 2nd when the president actually rolls it out. With that big caveat, we do see some evidence that at least the cabinet, at least the senior members of the administration around the president, are now planning for a somewhat narrower set of tariffs on April 2nd than we had been hearing about a couple of weeks ago.
It might actually fade, or really trying to avoid leaning into the rally that you might see in information technology or consumer discretionary or communication services, because those names are going to be whipsawed around by every single headline with respect to not only tariffs, but PCE on Friday, which also could be another surprise for the market as well. So I would hold back on making any big moves until we actually get past the first week of April and really into earnings season.
Tesla's essentially becoming an ordinary car company. And when you treat it as an ordinary car company, you look at it and you realize it's got an aging lineup. There's nothing really exciting coming down the pike anytime soon. They gave up a major competitive advantage last year in sharing their charging tech, and they made a big bet on automation.
We got an hour to go until the market close, so let's take a check on where we stand on the major averages. And the tariff talk today, those reports about maybe a little bit of a narrower scope of tariffs going into effect on April 2nd and being announced on April 2nd, giving a little bit of relief to the market. So the Dow is up 528 points right now, 1.25%. The S&P 500 up 1.6%, and the Nasdaq leading the way up 2.1%.
We had this big date circled on our calendar.
Yes.
It's April 2nd, right? That's when you expected these wide-ranging levies. That's when they were expected to be implemented. And of course, Trump calling, I believe it was Liberation Day. It was a big day, and investors had all kinds of questions about that in terms of the levies, in terms of the impact on the markets and the economy. Today, though, now we have these reports that maybe Trump could be softening perhaps his stance on those reciprocal levies, maybe narrowing the scope and scale, and that's enough to send investors piling in. Well, we're not sure, though. There's plenty of uncertainty.
We're not sure, and the reports don't seem like they're being narrowed by that much. They still talk about our major trading partners being affected by these reciprocal tariffs. Maybe some of the tariffs against particular industries, autos, for example, chips might not go into effect right away, but then Trump coming out today and saying they will go into effect. It just might not be on the same timeline as was estimated. So it's not as though the much discussed uncertainty that we've talked about in the market is going away.
And to your point, it's not just size and scope. Then you also have to think about, if you're an investor, well, size and scope, and also if they get imposed, how long lasting would they be, right? Another big question mark.
I think indefinitely, especially if Trump is seeing it as a revenue source, which he seems to be. So all of this said, yes, we are seeing stocks rise for the moment here today. And in terms of what's rising, a little bit of everything. When you look across the groups in the S&P 500, consumer discretionary, the XLY doing the best, followed by tech. And consumer discretionary, the best performer in there is what some might think of as a tech stock, some might think of as an auto stock. I'm talking about Tesla, which is on track for its biggest one-day gain going back to election day here with this 10% bounce that we are seeing today.
I look at the Magnificent Seven broadly, and some of those names have really taken it on the chin. If you were looking at the MAGs, which is the ETF that tracks the group, it's still down more than 10% year to date, but you can see these names catching a bit here today.
Yes, catching a bit on this little bit of a relief. Even the companies that are not directly affected by tariffs, they have been hit by the sentiment surrounding the tariffs, which is interesting to see. One other asset that we've been watching here today, Bitcoin is also catching a bit as we're seeing this risk-on sentiment come back into the market. It's pushing up above 88,000. So risk on today. We'll see if that sentiment can last.
Let's ask a very smart strategist whether it can last. For more on the latest market moves, let's welcome in that strategist right now. That would be Scott Cronert, City Head of U.S. Equity Strategy. Scott, it is great to see you. So, listen, I was just talking to Julie there. We're in rally mode today, Scott. We have these reports. Maybe President Trump could be softening his stance on these reciprocal tariffs. Do you look at this market action, Scott, and tell your clients, you know what, maybe the worst of this recent pullback is in the rearview mirror, Scott?
Well, I think we're pretty comfortable that the 5,500 level has been a level that we've talked about for the past 2 or 3 weeks that we think gives you a pretty good risk reward, where we know that we're going to have some form of tariff overhang that's going to be with us for some time now. I think you guys were right on with your earlier comments, Josh and Julie, in terms of, when you're looking at tariffs, it's a combination of magnitude of tariffs and also duration. And to your point, we also know that the tariffs, the broader tariffs, are going to be an important element of the revenue raise component of the broader, Trump policy. Now, at the same time, we also know that investors have been concerned about tariffs for, at least 6 months, if not a year, if not longer. And so to a certain degree, a lot of the angst has been getting priced into the markets. And I think what you're getting, as you point out, is with a little bit more sign of some rationality around the timing and magnitude that you give the market room for a short-term move to the positive right now.
So I guess then the question would be, Scott, what is the base case that you're assuming on tariffs at this point? And is that, in fact, priced into the market, even with the bounce that we've seen over the last week or so?
Yeah, so the base case that we've been talking about, Julie, for probably going on 6 months now, is that you give me an across-the-board 10% tariff, okay, and all things equal, we think that is roughly a 6 percentage point drag on the S&P 500 earnings outlook. Now, keep in mind when we talk about tariff impacts, many will go down the path of saying, gosh, tariffs are going to be net inflationary. Our view is maybe, but we think the bigger issue is probably in the gross margin side. As companies, we think will have a harder time passing through some of the price increases that come with this. So we're very sensitive to what's being priced in at the company's specific level, where each company is probably going to have a little bit different persona in terms of how this plays out. Bottom line, I think it's hard to judge that we've been fully priced in until we get a little bit more clarity. We also think that going into the Q1 reporting period, be prepared for another bout of volatility, because we suspect that more C-suites will be talking about their views of how tariffs may influence their fundamentals, and the analysts are going to be responding to that. So net, we're getting a pretty negative revision dynamic at work right now. I think it's going to be very stock specific, though, as we go into the reporting period in terms of how this is going to play out. But generally speaking, we think a lot of the angst is mostly priced in at this point.
Scott, I want to get your thoughts on the Magnificent Seven as well there, Scott. Some of those names have taken it on the chin, of course. If you look at the MAGs, the ETF that tracks that group, it's down more than 10% year to date, though it's catching a bid here today. Scott, I'm just curious to get your thoughts on the Magnificent Seven.
Okay, so let's talk about this. So index from the Feb 19 peak to the week ago Thursday low was down about 10%, S&P 500. The Mag 7 from their 52-week highs were down over 20%, with certain of the components down even more than that. What that had done, honestly, is take the valuations for that component of the market down to a less negative area versus its 20-year average relative to the other 493. So what we've been arguing, Josh, is that from that point over the past couple of weeks, this growth is defensive component and element, as you think about the Mag 7, comes back into play. We think their fundamentals are in pretty good shape in terms of expected growth trajectories for this year. We're not sure we can say that about the rest of the index as we go through tariffs and as we go through signs of economic sluggishness. So all told, our view here is that the mega cap growth cohort led by the Mag 7 takes on a little bit more of a growth as defensive bias as we go into the quarterly reporting period.
So just to put a fine point on that, I mean, obviously people have a lot of Mag 7 already, right? Most people in their portfolios. Would you suggest adding to that here as we have seen this sell-off? Or do you think just hold on to it? It's an area to perhaps shelter or ride out the coming volatility?
I think it's the latter point, Julie. We want to hold on to those positions for now. You're in betwixt between in terms of, do you outright sell or do you buy into pullbacks? I think there has been a lot of element of lightning. The price action down 20% plus in aggregate tells you that that's been going on to a certain degree. Fundamentals are very good shape. What I would say, though, is that we've been saying for some time that what you have to expect is less of a decisive price action for the Mag 7 versus what you got in 23 and 24. So we've been all about broadening as a bigger thesis going into this year. It's acknowledging that the Mag 7 are going to be an important component of that, but they don't necessarily need to be the driver of aggregate index returns as we go through the balance of this year.
And Scott, when you're talking to your clients right now, what sectors do I want to be overweight in?
Well, I think the ones that are probably getting the most attention, quite honestly, we went overweight healthcare going into this year after being underweight last year. And it's a sector that had really multiple contracted over the past 6 months and had fallen quite out of favor. So we think as a defensive sector, that's kind of back to life. On the tech side, where we've been market weight, we've been more focused on the semiconductor component. So for that growth exposure, we like semis as well as the media entertainment or internet companies. So we're focused on there. We've had an ongoing positive view towards the financials. And for an added twist, we have been overweight energy going into this year, which has actually been a pretty decent outperformer. So we think there's a very good balance to be drawn here between growth, classically defensive, and even classically defensive as well.
I was also struck, Scott, in a recent note where you talked about that money that maybe had been going, sort of down, I think down market is what you call, down market cap to the small and mid cap space has been flowing into places like Europe instead. Do you think that is indeed where people should be looking? Because it sounds like you still think maybe there's some opportunity in those small and mid caps.
Yeah, so I think the small mid-cap space is still in a tough place. We need to see more evidence of a traditional fundamental turn to the positive, which we haven't gotten yet. I think that exists on the other side of the full brunt of the tariff proposals, but we're not there yet. In the meantime, in Europe, what you're seeing is a very clear early cycle dynamic where the ECB is in position to ease further. But importantly, a lot of this focus on, let's say, the European economies paying their way, particularly on defense spending, is adding a new fiscal impulse to the positive there that we haven't seen for some time. So the Europe outperformance potentially has some legs here, but also what we've noted in terms of the movement down cap, the S&P top 50 had been such an outperformer over the past 2 years, but so far this year, the top 50 has been lagging that component of the S&P below it. So what we're seeing is some broadening within the market, according to sectors, and additionally, I think this push down the international path is starting to raise some eyebrows as well.
Scott, great to catch up with you as always. Thank you. We're just getting started here on Market Domination. Coming up, BYD shares rising after the Chinese electric vehicle maker reported higher quarterly automotive revenue than Tesla for the first time. We'll check in on some of today's top trending tickers on the other side. Plus, the genetic testing company 23andMe, once valued at $6 billion, it's filed for Chapter 11 bankruptcy. We'll get you the details later in the hour. Stick around, much more Market Domination still to come. Now time for some of today's trending tickers. Let's start with Hyundai. The automaker is mounting a significant expansion in the U.S. as it looks to avoid President Trump's tariff threats. The president spoke about the South Korean company's plans just moments ago.
This investment is a clear demonstration that tariffs very strongly work, and I hope other things also, but the tariffs are bringing them in at levels that have not been witnessed. Hyundai will be producing steel in America and making its cars in America, and as a result, they'll not have to pay any tariffs. You know, there are no tariffs if you make your product in America.
Joining us now with more is Yahoo Finance's Pras Subramanian. Pras, explain this to us here, because I assume that Hyundai is not going to make all of the cars it sells in the U.S., even after completing this plant. But what's its manufacturing footprint like already in the United States?
Right, so they actually have a plant in Georgia where they make a number of cars there for the U.S. market, right? They've been localizing production in the U.S. for quite a while now, Hyundai and its sister company, Kia. This particular project is for a steel plant, I believe a $5.8 billion steel plant, creating more than 1,400 jobs, Trump said at that press conference. Like I said, like he said, no tariffs if you make stuff in this country. But Julia, you raised a good point because Hyundai's other cars that come imported from South Korea don't pay any tariffs either because, surprise, surprise, we have a free trade agreement with South Korea. And we also do for Canada and Mexico. So people like Ford CEO Jim Farley asking, well, why aren't you tariffing those products from South Korea when they get in scot-free, and then you're making us pay for the stuff we make in Canada and Mexico, our supposed free trade partners too. So all this is good news for Trump and Hyundai in particular. The auto sector is still kind of left in an uncertain world here as to how they should appropriately act. Does that mean everything must be made in the States and not anywhere else, unless you're South Korea?
And separately, Praz, BYD stock also popping today after earnings. What can you tell us about that?
Big year here for BYD, China's preeminent sort of automaker. Revenue up almost 30% year over year. Net income up 34% in 2024. A mix of hybrids and EVs is appealing to the customers there, both in China and also globally. Tesla does not have that. We also saw that BYD announced a new Model 3 competitor that costs half as much and kind of has the same range. So that's a tough sort of competitive landscape for Tesla in China, where let's be clear, BYD does not have the brand cachet that Tesla has or even NIO, but they're bringing stuff like self-driving technology and that battery breakthrough. We saw 5-minute charging to their cars that are significantly cheaper than Tesla, and that's a big problem. And that could also widen BYD's appeal and competitive sort of setting there in China.
So we're focused on China and the competitive landscape there. And we also, I believe, got some new numbers out of Europe about how Tesla is doing against some of the other big car companies there.
Yeah, seeing some of these German rivals selling better than Tesla compared to Tesla, which does operate a gigafactory in Berlin. According to data from Jado Dynamics, they've done some research and found that BMW and VW products, EVs, are selling better in February compared to Tesla. This is as Musk standing in the country by backing the AfD movement. It has taken a hit on his public polling, right? But also I want to note that German automakers have been making some good EV products for quite a while now. In particular, BMW is selling very well, topping, in fact, Mercedes and VW combined in the US, but in Germany in particular, doing quite well. So the question is, can Tesla, with both an aging product lineup with the new Model Y coming out, can they compete on terms with German rivals who are better now, with the overhang of bad PR, a bad Tesla brand image, a bad Musk brand image?
All right, Praz, thank you so much. Appreciate it.
Thank you.
Our next trending ticker, Oklo, that stock is moving higher today after the company said it was started working with the Nuclear Regulatory Commission to prepare for a license application to build small modular reactions. Julie, the company says it's been engaged with the NRC since 2016. It's completed extensive pre-application engagement. Company's co-founder and CEO saying we continue making progress towards obtaining commercial licenses for next generation nuclear technologies. Yeah,
to be clear, this is ticking the box as part of a long process. Let me remind people what this is. This is a pre-application readiness assessment, okay? And so Oklo's products, to remind everyone, they are aiming to make small modular reactors. Those reactors do not exist yet. What they are aiming to do is to build a demonstration reactor in Idaho. That's what they're pre-applying to do. So just a reminder there for folks, but it's just another step towards that process. They expect that first small modular reactor to go into service in 2027. So this is all part of that process here. The company is set to report earnings tonight, but it's not expected to make money for the foreseeable future. It doesn't make revenue yet. It is a pre-revenue company. But the reason that the stock has risen, and it's all, more than doubled, almost tripled over the past year, is on the promise of this technology and on the AI-powered demand for nuclear energy.
Plenty of enthusiasm.
Plenty of enthusiasm. It's backed by Sam Altman, so
that doesn't hurt either.
It does not hurt. So we'll see what ends up happening. And then also we're watching a company called Intuitive Machines. Those shares are also soaring after the moon exploration company revealed fourth quarter revenue jumped on the back of higher contracts. It reported a stronger cash position, and also its fourth quarter backlog was up by 22%. Now this company has faced some setbacks. As we know, it's landed a couple of modules on the moon that didn't get there intact and weren't able to gather all the information that they wanted. So investors may be looking for something to hang their hats on here.
Yeah, the company did say Q4 backlog has increased 22% year over year. I think that was the highest quarter ending backlog in its history. End of Q4, just to put a number on that, it looks like backlog of about $328 million, and looking ahead sees 2025 revenue between $250 and $300 million and positive adjusted EBITDA by 2026. And look at that moving today.
Yeah, I mean, to point out as well, the stock is down more than 50% year to date on some of those challenges. So this pop coming after what has been a pretty tough performance. Well, shares of direct-to-consumer genomics company 23andMe shares tanking today. The Silicon Valley company losing more than half of its valuation. That's because it filed for bankruptcy protection on Sunday after failing to find a buyer. Yahoo Finance's Alexis Keenan has been looking into anticipated battles in bankruptcy court, and that's because, in part, they have a lot of personal information, genetic information.
Sensitive information, and they boast that they have 15 million consumers worldwide, a lot of those in the US. And the bankruptcy attorneys that I've been talking with say that, well, because the US does not have a comprehensive biometrics data privacy law that protects all of us in this kind of information, that it's going to be a battle in court, because what is this company's most valuable assets? It's data. It reported in the bankruptcy filing that at the end of 2024, it had $277 million in reported assets, debts of $215 million. And so it's really going to want to hang on to as much as it can. However, it could come down to kind of a state-by-state battle. Where do you reside when you contracted with this company in order to submit your swab and get DNA information, ancestry information? And so there are a handful of states, well, I should say more than a handful. There's about 22 states that have really robust biometrics data privacy laws. And those are the states in which the consumers will have a right to say, perhaps, well, I'd like my data scrubbed. Now, the company promised its consumers that they could scrub their data if they wanted to at the request of the consumer, but that's not necessarily how it's going to play out, these lawyers tell me, because if you live in a state where you don't have these laws on the books, minus a federal requirement to adhere to that scrubbing, that the company's really going to try to hang on to what it can.
So it files for bankruptcy, Alexis. What's the next steps? What's the timeline for this company?
Yeah, so this week a lot will happen in terms of just the really traditional types of things that the courts need to go through. They'll be talking about leases and different things that they can, the company can be protected from, right? Because the object here, it's a Chapter 11 reorganization. The company is asking the court to okay a sale of essentially all of its assets at auction. So they're looking for a buyer. They actually had the CEO and co-founder, Ann Wojcicki. She had submitted bids during this last, I want to say, year or so, wanting to take the company private. The board not really happy with that. That led to all the independent board members resigning from the company. So that deal already rejected, but the court is now going to start setting up a process where it's going to formalize this bidding process. No buyers, as far as I know, on the table as of today, but a lot will happen. But initially, it'll just be some traditional things like trying to get out of its contracts. Bankruptcy, Chapter 11 protects the companies from their liabilities. So a lot more to come here, and certainly will be a battle in terms of privacy data protection.
All right. Thank you, Alexis. Keep watching. Coming up, the aging population is creating an attractive investing opportunity in REITs. We're going to be talking to an analyst about why. Much more market domination still to come.
Time now for some calls of the day. We'll start with some steel production names. UBS getting more bullish on Nucor and Steel Dynamics. The firm lifting ratings on those stocks from neutral to buy, and basically saying that they're looking at the sort of tariff landscape here. And they say that the tariff protection for U.S. steel and aluminum has exceeded our expectations, and that there's been a rally in the finished steel prices for these companies. And so that is one of the reasons, Josh, behind this this upgrade that we're seeing.
Yeah, it does say we think steel prices will fall in the second half after near-term panic buying subsides, worry that the unpredictable U.S. trade policy impacts demand, but they do go to a buy. Their target's 160. That wasn't the only one, by the way. It looks like they also upgrade Steel Dynamics to a buy.
Yeah, Nucor is the one you were talking about.
Yes, and then Steel Dynamics goes to a buy as well. So we think any demand side is likely to be partly offset by reshoring efforts, and the import protection is more significant. The target on that one is 149.
Yes, exactly. Interesting. Timely to get a note like that as we're looking at all these tariffs.
For sure. All right. Meanwhile, Jefferies shrugging off some of the macro outlook for FedEx and drilling in on the cost transformations taking place, lifting that name to a buy as well, saying with the market overly distracted by the broader macro, they say we think investors are ignoring the idiosyncratic cost transformation going on at FedEx under the surface.
Yes, Drive is the name of that cost program that FedEx has been working on for the past couple of years here, as it also plans to separate its business of freight from the express. And essentially the analyst here says that there is this maybe antiquated idea of FedEx as being very indexed to the economy, and not only that, leveraged to the economy, but because of this cost savings, it makes them, the analyst argues, less vulnerable in any kind of environment, really. So it's an interesting view that the market is not the market's thinking hasn't sort of caught up with where FedEx is right now.
Yeah, and FedEx did recently report results,
Yes.
which we talked about, and they lowered profit guidance, and investors weren't happy about that one bit. But Jeffrey steps in and says, listen, risk reward's compelling. They put the target at 275. Looks like the average target is around 287.
And also, let's talk about coffee. Dutch Bros getting an initiation over at Morgan Stanley with a bullish overweight rating. The firm highlighting the coffee chain is hitting its stride on development and comps. Morgan Stanley pointing out that this is now the third largest coffee shop chain in the U.S., which I did not realize. I assume behind Starbucks and Dunkin', I'm guessing. And they talk about that they have more room to expand here. Have you ever been into Dutch Bros? I've never been into Dutch Bros. They're not concentrated in the Northeast, so I haven't had the opportunity.
But they got fans, including investors, by the way. This one, a huge move for this. Over the last 12 months, it's more than 100%. Morgan Stanley likes this one regardless of that. They obviously still think there's more room to run. They talk about near to medium term sales drivers, food, mobile order, ongoing focus on marketing, innovation, and rewards.
Yes, and they talk about how many of these there could be. They say the company, I guess, has targeted 4,000 plus stores, and they said they ran an analysis, and they said, yep, that number is doable to us.
Yeah, it's a lot of coffee.
Yes.
All right, one stock getting a lot of traction, as always, would be Palantir, down from those February highs, but still up over 150%. That's just in the last 6 months. Joining us now to understand the moves a little more is Kenny Polcari, Slatestone Wealth Chief Market Strategist and host, of course, of the Yahoo Finance podcast, Trader Talk. Kenny, great to see you on set.
Great to see you. Thanks for having me.
Let's talk Palantir. It's always a hot name, right? Give me the Kenny take.
Listen, so you have to, if you look at it even broader, it's up 390% in the last year, right? We saw that explosion on February, I think it was the 5th or 6th, when the earnings came out, where there was this huge gap up, and then it traded all the way up. It's come back to fill that gap, which is absolutely, you want to see that kind of as a technical correction, right? You always want to see a stock fill the gap that it creates, whether it's on the downside or the upside. You want to see it come back and fill it and then test, which is exactly what it did. If you look at the chart, you'll see that. It's come right back to the levels where it was trading before it gapped up. Traded there for a couple of days, and now it's starting to lift its head again and move higher. Look, Palantir is going to be a name that's going to play a significant role in the economy, the global economy, and in AI for a long time. So, I wouldn't be a seller of this name. I wouldn't be chasing it. I didn't chase it when it was trading at the tops, but down here when it broke down, absolutely.
Okay, so let me ask you about the broader market then. After the week that we had, showing a little bit of recovery, now showing a little bit more recovery today.
Yep.
So what does that chart look like to you then?
So look, part of I think the recovery today is a talk that the April 2nd tariffs are not going to be the big bad boogeyman that they were a month ago, right? He's already said that he's pulling back on some. It's only going to be reciprocal. It's not going to be what necessarily everybody thought. So the angst that created in the market a while ago is now starting to repair itself. But we had a lot of technical damage done to the market because of the speed at which we declined, right? And so the market's got to thrash around a little bit. And while I love the fact that today the market's up, my portfolio's up, client portfolio's up, I'm very happy about that. I don't necessarily think it's completely over yet. I don't think you're going to get this V-shaped recovery. I think you're going to get this back and forth and this thrashing around until such time that we get through the end of the quarter. And then we get through tax season. I think between now and April 15th, you're going to have continued volatility. But then I think the market broadly starts to build that base and move higher. I'm very positive and bullish on the rest of the year.
So on the SPX, on the S&P 500, the levels you would be watching, walk me through it.
So right now, 5742 would be resistance. 5500, 5504, I think is the exact number, was the pullback that we saw, the decline, the worst part of the decline. So I'm in between 500 and 5750, let's say. I don't know where it is today because it's up substantially today. Is it up at 5750? I haven't seen it because I've been running around.
Yes, it's a little bit above 5750.
Okay, so it's trading right there. So now it's going to be important. Does it close above that? And then what happens tomorrow? I think it's going to run out of steam here. I think tomorrow I wouldn't be surprised if we saw it pull back a little bit, because don't forget, a lot of people get slammed on the way down, and so they're trying to trade their way back and create alpha. So when you have people that bought it at the S&P when it was trading at 5,600, when it trades up to 5,700, they're sellers. Trades back to 5,650, trades back to 57, they're sellers again, right? So they're trying to create alpha. So let's see how it closes tonight. Let's see where it closes. Does it close above that line or below that line? Because that's going to kind of then set the tone. But I'm still looking at right here, 5750, to be a level where it's going to find some resistance. And I don't think that's a bad thing. I think it's actually a good thing that it finds some resistance there, forces it to pull back, build more of a base until it surges higher again.
I want to ask you about some other dates, too, because we're talking about April 2nd. You talked about April 15th, tax day.
Tax day.
Maybe things getting a little quieter after that. But then we get into earnings season, right? And, we've seen earnings estimates start to come down a little bit.
Right.
Are we setting up for maybe some warnings from companies?
Well, I think you've already seen some, right?
Yes.
Nike reported last week they came down, or they disappointed, right? And they cut their estimates. I think FedEx, to your point, FedEx did it as well, right? So I think you're going to start to see estimates come down more before earnings season start. I think it's the 11th of April is when JP Morgan kicks it off officially. But look, I think we came into the quarter with thinking they were going to grow at about 11.5%. I think now it's around 7.5 or 8%. So I think that's also part of the reason the market pulled back, because it had to reprice itself based on the new expectation. So what we hear going forward is really going to be important, because the earnings are history. They're done. You can't do anything about them. It's what they're going to say going forward. How cautious or not they're going to be is going to kind of drive the next action, which is why I think, I think we're going to see a little bit more volatility go just as we get into that early part and we hear what they have to say, what they're concerned about that maybe other people are not. I don't think it's going to be tariffs anymore, because I think the whole tariff conversation is taking care of itself. I think, like he said, on April 2nd, it's not going to be the tariffs we thought it was going to be. Yeah, is he going to hit them with reciprocal tariffs? Yes, but watch how fast they come to the table, and then that's going to start that conversation. Exactly, but let's just see. I'm being positive, but let's see.
I mean, he also sees tariffs as a revenue source.
Of course, yes,
so
he does.
You don't want to negotiate your way out of a revenue source if that's how you view that.
Well, I hear you, but I don't. I think he sees it as a revenue source. I don't.
Well, it depends. Sometimes it's a revenue source. Sometimes, no, really, but sometimes it's national security. Sometimes it's just a leverage tactic, right?
Correct. So I think it's all very. I think it's. He's created a lot of anxiety around it. Now it's just going to play itself out, and I think that the fact that he already said that April 2nd is not going to necessarily, he's putting some off, it's not going to be as much as he thought, it's only going to be reciprocal tariffs, some countries are already coming to the table, so let's just see how it plays out. I'm not going to get nervous or anxious about the tariffs, because I don't think it's going to end up being an issue.
Okay.
On that note.
If you're not anxious,
I'm not anxious.
we're totally relaxed. Thanks,
Look how
Kenny.
relaxed do I look?
Thanks, Kenny. And be sure to tune in every Wednesday at noon Eastern to the Yahoo Finance podcast, Trader Talk, hosted by the always relaxed Kenny Polcari. You can scan the QR code below to stay up to date with the latest content. Here's a look at the latest episode.
One day the news will tell you that, it's about demand destruction and waning demand. And then the next day they're going to tell, China's back and so demand is strong. I think demand is strong. I don't listen to any of it. I don't think demand is going away. I think it's clearly a supply issue. We have a lot of supply.
I agree. And I think what the balance in the market's trying to figure out, right? Like now we're realizing that this energy transition move to 100% renewables is not happening. So that's going to keep demand stable. Now we get into the question is how quickly can we bring new supplies online? And if you look, what happened, the majors are in a capital discipline mode right now. They're not in rapid expansion. They're going, let's maintain the balance sheet, pay out stated dividends. Because what people don't realize is when you frack a new well, it depletes those reserves 50 to 60% in the first 2 to 3 years, right? So if you start expanding, you have to commit to keep expanding to maintain that level of production.
Well, so is what you're doing in Colorado, is that fracking?
Yes, yeah, it's fracking.
It's fracking.
Yeah, so it's fracking and horizontal drilling, right? So it's what's going on in the basin and has been right now. That, like I said, that basin started being drilled in the 60s and 70s, traditional vertical drilling. Yeah. Now what you're doing is fracking and horizontal drilling.
So fracking, because then explain to me or clear it up for the listener. Fracking versus just drilling.
Fracking, you're going to go in and split and open up the layers of shale. It's a different geology of the rock. So you're trying to get to those reservoirs, and you have to pump liquids down to open up to release,
break up the rock
to release
to
the
get
oil.
in there.
So traditionally, most basins like the Permian are very liquidy. You got to pump down a lot of water and a lot of sand to get the oil out. The DJ Basin is much less so that way. So it's minimal water and minimal sand compared to some other basins.
Right.
So again, it gets back to this is one of those areas, an untapped resource that hasn't been exploited as well as some of the, and it's not trading at premium valuations like you see in the Permian.
Okay, so are the other independent producers like not so that it's it is independent.
Yeah, it is independent, yeah.
Analysts are expecting the 75 and over age cohort to represent 10% of the total U.S. population by 2030. That's according to a recent note from Mizuho. And over $1 trillion spending opportunities expected with that aging population, setting the stage for potentially attractive investments, particularly in real estate investment trusts. For more, we're bringing in Vikram Malhotra. He is managing director and senior analyst at Mizuho Americas. Vikram, I know that the note overall from you guys talks about all of the different market opportunities and possibilities here. You focus on the REITs and senior housing REITs in particular. What is this aging, the silver tsunami, as you guys call it, what is that going to mean for these companies?
Yeah, it's a good question. So first of all, I think there's a trend here amid all the tariff talk, uncertainty, potentially all artificial intelligence boom. There's a trend here in aging intelligence that's very visible, it's durable, and it's very actionable, particularly for the senior housing REITs. What it does do is two things. I think one, it gives us more visibility into the top line rental growth of these seniors housing companies, both in terms of occupancy and pricing power. But it also means that there's a lot of investment opportunities for various REITs like Welltower in this space. So I think it's a very interesting time, but it's also very actionable, which allows these REITs to see an elongated trajectory of revenue growth.
This silver tsunami, Vikram, that you talk about, can you help us think through that and quantify that? How big is that tsunami now, and what do you see ahead?
For sure. So today, the 75 plus cohort represents about 7% of total population. We think that grows to about 10%, by 2030. From a spending standpoint, when you marry the population growth and you combine that with the per capita spend of the seniors, particularly on things like housing, healthcare, medical services, we think the growth rate of the seniors in terms of spending will be above 80%. That's almost 2x the growth rate of the average person in the US. And when you step back, we think the senior, which in many instances is probably the least most important consumer, will become either the third, the fourth, maybe even the second most important consumer, depending on the category.
Vikram, as someone who is a member of the sandwich generation, so-called, with aging parents, I happen to know that this stuff is very expensive. And so I'm wondering, is there going to be an affordability issue on the part of aging seniors to be able to live at some of these developments that you look at?
Yeah, it's a very good point. So just to put it in context, in New York, for example, the average rent for, say, a studio could be at least $15,000, if not $20,000 a month. At the face of it, it's sticker shock. But the way these seniors pay for the rentership costs is by selling their home or drawing on home equity. The average, call it 2-bedroom in New York, is probably at least $2 million. The average length of stay tends to be 2 to 3 years. And then remember, again, Welltower and Ventas are catering to the higher income seniors. But that's essentially the math. You sell your home in New York for $2 million. You have a 2 to 3 year period of stay, and that's how you fund the $20,000 per month.
In terms of names you don't like, Vikram, off this play, what are names that you would consider more challenged off this thesis?
So as seniors, as you have an aging population in the US, you'd imagine one area, for example, that could be net pressured would be food consumption. I'm sure we talk to our grandparents, they consume less, perhaps less meats, less heavy food. On the margin, less food consumption perhaps is a headwind for, say, cold storage. We cover a company called Lineage, for example. Over the long term, we think food consumption could pressure volumes in cold storage. Office is another example. I think it's well known, but the senior cohort are probably heavy users of not only the office, but also in terms of the closed systems within the office, having more office space as opposed to open layouts. So one of the areas we'd be watching is, as seniors age, does densification in the office become a problem? And therefore, the future demand for office is somewhat hampered as well. So those are two segments I would say are somewhat net negative versus the seniors, which we think is a net positive.
And the two picks that you really zero in on, Welltower and Ventas, the ones that you do like and that are going to benefit from this trend, what are the things that are specific to them? You mentioned that they cater to a higher income cohort. Is there something else about them that makes them particularly attractive in this scenario?
They do. So Welltower, let me start there. So they have a very, very strong balance sheet, just over 3 times debt to leverage. They have an ability to grow the company very rapidly through external growth. As there's more distress in the market, they can really tap both their equity and debt and grow. And I would say that TAM for a company like Welltower is almost 3 to 4x if they'd like to grow their portfolio. The other thing about Welltower is they have spent a fair amount of money building a platform using data and analytics to make the space much more institutionalized. And that puts them head and shoulders above everyone else. That is why that's our top pick. We see nice upside from here, and the premium multiple sustainable. Ventas, it does look cheaper. It's sort of a cheaper way to play the senior housing silver tsunami. It's trading at about the market multiple. They do have a similar portfolio, perhaps more US and Canada focused, but very, very strong growth. And they too have just started growing externally. So I would say it's a combination of the very strong internal growth, external growth, as well as the platform that these companies have created.
Vikram, thanks so much for your time today and those recommendations. Appreciate it.
Thank you.
Shares of Ubisoft are surging today after a successful release of Assassin's Creed Shadows. The game surpassing 2 million players over the weekend, something Ubisoft desperately needed from its flagship franchise as shareholder pressure to take that company private continues to mount. We are navigating how to play the whole video game sector with the Yahoo Finance playbook. And joining us now is Michael Pachter, Managing Director of Equity Research at Wedbush Securities. Michael, great to see you as always. So let's talk about Ubisoft here. It's surging about 8% in today's trade, Michael. Does that move make sense to you, Michael? Is it justified?
So Tev, you know that I'm a silver senior, and I used to be head of strategic planning for an oil company. So you have me right in the right row, in the right block of content. Look, I think a lot of people gave up on Ubisoft when they pre-announced this year, and they had started the year saying they were going to earn 400 million euros of operating profit, and they changed that to 0. So, clearly a disappointing year. And a lot of people really were spooked when Assassin's Creed was delayed out of holiday. The company said the reason for the delay was they're trying to polish the game and get it right. A big contributor to that was the trolls on X and other social media platforms were really bashing the game because it has a black samurai as a main character and it has a female ninja as a main character. And the trolls just said it's not right. You can't have women or black people in Japan, that are powerful and strong. It happens there really was a black samurai in the real world back in 1600, and this is historically accurate. So, there was a lot of concern that the game might get bad reviews. It got great reviews. And in fact, 2 different reviewers have told me it's their game of the year. It's pretty clear Grand Theft Auto is going to be game of the year, but absent that competition, this would be right up there. So the stock is rallying because expectations were low, and the company has delivered something that's really good. The early metrics, 2 million users the first 2 days is a lot, so they're doing really, really well.
And Michael, there's been a lot of talk prior to this about Ubisoft potentially being up for sale or just seeing some kind of deal. From a stockholder's perspective, does that need to happen at this point, or does the success of this game buy them a little bit of cushion here?
They weren't under pressure to sell. It was more that they were trying to just get out of scrutiny. And they have a big investor in Tencent, the Chinese conglomerate. Tencent, I think, owns about 10% of the stock and has a right of first refusal if the company is put up for sale. I think the management team thought if they whispered that they were in play, Tencent would buy them, leave current management in place and be a benevolent owner. Tencent actually came out and said something to the effect of, we need some changes if we were going to buy the company. The problem Ubisoft has is they have 17,000 employees, and that's down from 19,000. So they're trying to get thin. They're thin like I am, right? Electronic Arts has 12,000 employees and is twice as big. Activision, before they got acquired, had about 11,000 employees, almost 3 times as big. Take-Two is more than twice their size with about 12,000 employees. So 17,000 employees makes no sense whatsoever. It actually comes out to be about $100,000 of revenue per employee. And you just cannot make money that way. You're generating revenue equal to your payroll. So, these guys, they brag that they're in low-cost areas. No one can buy them unless they're going to lay off a whole lot of employees. And with a French company, that's hard to do. So I don't expect an acquisition unless the Saudis decide to get involved. If Saudi steps in because they can relocate, jobs that they captured through attrition into Saudi Arabia, that's kind of a goal of the Public Investment Fund in Saudi Arabia. And Savi's mission is to kind of bring jobs to Saudi Arabia over time in this industry. So Ubi would make a lot of sense for them, no sense for anybody else.
Switching gears, Michael, GameStop, earnings on deck tomorrow after the close. I know you rate this one underperform, I believe. What do you expect to hear?
GameStop is the rich man's MicroStrategy. So if you're not happy with how MicroStrategy is performing and you want to pay even more for even less, you can buy GameStop. They have about $10 a share in cash, and they traded about 25. So you're valuing their operations at 15, and they haven't made an operating profit in a full year for 4 or 5 years. They're not going to make an operating profit in the year they're about to report. They're not going to make one this year or next year or ever. So if their operations continue to lose money, it's hard to value them at several $1 billion, and the market's just got this one wrong. The company's strategy, which has changed about 6 times in 3 years, is they're going to buy cryptocurrency and be just like MicroStrategy. The problem with that thinking is MicroStrategy trades at about 2 times their Bitcoin holdings. If GameStop were to buy all Bitcoin with their $4.6 billion in cash and trade at 2 times, the stock would drop $5. So if they get a MicroStrategy valuation, they're worth 20. If they get a cash valuation, they're worth 10. And I don't know why anybody wants to let Ryan Cohen buy Bitcoin with their money when they can buy Bitcoin themselves.
Plainly said, and that is why it is your only underperform, Michael. Good to see you. Thanks for your time.
For having me. All right.
Well, we're wrapping up today's Market Domination. Don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.